Welcome back to the channel, where we dive deep into the fascinating world of hard-to-borrow stocks and the mechanics of a potential short squeeze. Today, we're putting a specific microcap company under the microscope, AEHL. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Alright, let's talk about AEHL. This company has landed on our hard-to-borrow screener due to some very interesting metrics. As a microcap stock, it often flies under the radar for many investors, but when the cost to borrow starts to skyrocket, it catches our attention. From a price action perspective, AEHL has shown 0.0% change today, 0.0% over the last 5 days, and 0.0% over the last 30 days. Similarly, recent volume figures show 0 shares traded today and a 30-day average volume of 0 shares, resulting in a relative volume of 0x average. This lack of trading activity is a critical point we'll address. What is cost to borrow and why it matters? So, what exactly is cost to borrow or CTB? In simple terms, it's the annualized fee that short sellers pay to borrow shares they then sell. Think of it like interest on a loan, but for stocks. When a stock becomes hard to borrow, it means there are very few shares available for short sellers to borrow, and the demand to short those shares is high. This scarcity and demand drive the cost to borrow fees up, sometimes dramatically, even exceeding 100% annualized. Why does this matter? Because these fees eat directly into a short seller's potential profits, or worse, turn a profitable short into a losing one, simply due to the cost of maintaining the position. Why this stock is hard to borrow right now. Now let's get specific with AEHL. Our data shows a staggering annualized cost to borrow fee of 10.02% for AEHL. That's over 1,000% per year just to hold a short position. While we don't have information on the shares currently available to borrow, this extremely high CTB strongly suggests very limited supply. The estimated float for AEHL is 15.4 million shares. Our internal composite squeeze score for AEHL currently sits at 41.1 out of 100, which indicates a notable level of underlying conditions for a squeeze. The combination of a relatively small float and an exceptionally high cost to borrow is precisely why AEHL is appearing on our hard-to-borrow screeners. Squeeze mechanics explained. So, how does this potentially lead to a short squeeze? It's a feedback loop. Short sellers initially borrow shares and sell them, hoping the price will drop. If the price instead starts to rise, or if the cost to borrow becomes too punitive, these short sellers are incentivized to cover their positions. Covering means buying back the shares they initially sold to return them to the lender. This buying activity adds demand to the stock. If enough short sellers are forced to cover simultaneously, this sudden surge in demand can push the price even higher, triggering more short sellers to cover, creating a rapid upward price movement that's the essence of a short squeeze. However, with AEHL's current zero volume, it's critical to understand that this mechanism only kicks in when there's actual trading activity. Dilution risk check. One crucial factor for any potential squeeze thesis is dilution. New share issuance, like S-1, S-3, or 424B filings, can increase the total supply of shares, often diluting existing shareholders and potentially providing an exit for short sellers to cover without significantly impacting the price. For AEHL, we've found no recent dilutive SEC filings in the last 90 days. This means that, at least for now, there isn't an immediate threat of the company issuing new shares that could undermine a squeeze scenario. Recent reverse split watch. Another very important factor for AEHL is its recent corporate action. AEHL executed a 1-for-16 reverse stock split on August 10, 2026, which was just 0 days ago from today's date. A reverse split reduces the number of outstanding shares and proportionally increases the share price. For example, if you own 16 shares at $1 each, after a 1-for-16 reverse split, you'd own 1 share at $16. This effectively reduces the float. Historically, many microcap stocks tend to see renewed volatility or a price pop within about a month after a reverse split, though it's vital to remember this is a pattern, not a guarantee, and AEHL's current zero volume makes this a unique situation to observe. Again, important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given AEHL's incredibly high cost to borrow and its recent reverse split, what should you be watching for? First and foremost, a return of volume and trading activity. With 0 shares traded, any talk of a squeeze is purely theoretical. If volume does return, you'd then want to see if the price starts to climb, putting pressure on short sellers. A shrinking supply of shares available to borrow, combined with persistent high CTB, would be key indicators. Remember, a high cost to borrow does not guarantee a squeeze. It can also indicate that short sellers have very strong conviction that the price will eventually fall further, and they are willing to pay a premium to maintain that short position. The post-reverse split period, typically the first month, will be critical to observe for AEHL. AEHL is a fascinating case study with an exceptionally high cost to borrow and a recent reverse split that has reset its share structure. While its current lack of trading volume presents a unique challenge, the underlying conditions of high CTB and a small float mean it's certainly on our radar. We aim to equip you with the knowledge to understand these complex market dynamics. If you found this breakdown helpful, please hit that like button, subscribe for more deep dives, and let us know your thoughts or questions about AEHL in the comments below.